Hello, everyone.
Hey, sorry, I didn't know I had to let everybody in. Let me make sure I make everybody the right people hosts and everything. Let's see.
Hi, how are you all?
Hey, Richard.
Doing good, Richard. How are you? Of
Yeah, good, thanks. Nice to be here. Thank you.
course. How was your holiday?
Yeah, great. It was brief but wonderful, Observing plastic pollution in the ocean, though, is always depressing. So there's that.
That was I went to Norway a couple years ago, and we went like above the Arctic Circle and drove way out and
Oh,
on the
wow.
fjords, and it was wild walking along the coast of like the middle of nowhere, and how much like microplastic there was just washed up on the beach. It was like astounding.
It's just depressing. You know that the oil majors predict that 50% of their future revenue will come from plastics production there. So if you're wondering where they're going, after they've finished fueling vehicles and whatnot, that's the answer.
Well, let's hope they can figure out a way to make them more biodegradable.
Yeah, look, it's a real challenge. You could do a whole session on plastics. I'll send you some plastics info that is pretty eye-popping,
We
Oh,
just
please do.
watched, there's a documentary on HBO called Brandy Melville. It's about the store Brandy Melville, which my daughter worked at this summer, and it is a nightmare. But they also talked about fast fashion a lot.
Oh,
And
big
I
problem,
was
eh?
I was super like naive about like I thought that all the clothes that people just gave away like ended up like in Africa, but like poor people, like
No,
destitute people. But they're like there's these oceans with piles and piles of clothes.
no.
It's really horrifying. I had no idea.
Yeah, no, look, I think that our affluent areas are a part of this challenge. I think if you look at the emissions of poor countries, I mean, they are a fraction of wealthy countries.
Yeah.
So that's a real challenge. Would you like me to share my screen just so we can test that's working? Hi, Tanya. I'm
Yes.
Richard.
Hi, Richard. Nice to meet you.
Likewise, and you. Happy, thanks, and good to be here. Thanks for all your efforts.
Yeah, let's go ahead and test.
Okay.
Go ahead and test everything.
So let me just check that I've got the right thing. Okay, share and then full screen it. Okay. I actually to go and look for the tie, so I look like the same person.
Are you wearing the same tie? You're awesome.
I mean, Clark Kent and Superman. I don't know if I would have guessed it.
and trust me, I didn't look for it. I just I don't have that many ties. I was like, oh no, unlucky. Okay.
Oh,
Okay,
man,
great.
I said you could have. I know it's late there, so you could have switched to the T-shirt. Nobody would have judged
Oh
you.
no, it's no issue at all. Thanks. I think I'm super serious about this stuff, as I know you guys are, and I think anything that adds to that is helpful. So yeah, okay. So the slides seem to be moving, so
Yep.
there's no issue there. Let me just check that those animations are good. Yeah, they're all fine. And then, so how would you like me to proceed? I mean, you want to leave this on the screen while people join, I assume, so they know they're in the right
Yep.
place. Okay.
We'll
And then, do you want
have
to
some
talk to
music.
this slide?
Yep, we'll have some music queued up.
Okay, cool.
I guess actually just per Victoria, Valerie or Tanya, do you want to cue the music to have it play in the background so I don't have to worry about it, or do you want me to?
I would say, can you do it? Because that's one thing I don't. By the way, Richard, Tanya and I are both kind of learning how to do the back end Zoom stuff. So I don't have like a fine list.
Good luck with it.
So if you could do it, Jonathan, if you have, do you know how to do it? I don't even know how to do it.
I think you just play music. We'll
You
find
mean like
out.
in your
Can you hear
house, like
that?
just in the background?
No, we can't.
Okay. There's definitely a way to do that.
Yeah.
I think you'll have to select a speaker and it should say same as system. But this is just a wild guess, Jonathan.
Let's see, that'll be one of the, I think one of the hosts will have to do that.
If we don't get
Okay.
music, it's okay. I don't know why they get so caught up in that thing with work on climate. I was like, did you get the Spotify list? And I don't know. I don't think it's a huge deal how to play music. I'll look it
I
up.
know. I do know that the MSCI's head of sustainability research, the lovely guys based in Zurich, is also a DJ who makes climate music.
Oh, cool.
Yeah, it's pretty cool.
Cool. That sounds fun.
And then so yeah, Richard, you'll have that up. I've got a little script I'll read. I've got a couple lines I'll read right at 9, or sorry, right at event start time, and then we'll give it a couple minutes, 2 or 3 minutes, and then I've got a rest of a spiel to go through, and then I
Sure.
will say the floor is yours, Richard, and you take it
Perfect.
over.
Okay,
And
that's
then,
great.
yep. And then at the very end, I'll have we're gonna have that QR code, and I'll just say wrap it up by saying thank you. Please join Work on Climate. If you're not, fill out our survey. That you're gonna be around for the next
Great.
24 to 48 hours doing AMA. Join us in the finance community finance channel to ask your questions.
That's great. And so, the AMA, I'll log into tomorrow morning my time, but probably around 10, so that'll be 8 p.m. your time. So just to let you know, and then I'll see if there are any questions that need answering, and I'll kind of go back in the afternoon and check again. Does that make sense?
Yep, perfect.
Perfect. Could I ask you a favor? Could you resend me the link?
Yes.
Because I remember it's a Slack channel, but it's like, but you don't have to do it right now. I'm just being a lazy man. So thank you. So you can control the slides, Jonathan. Is that right?
No, I was gonna leave
Okay.
you to control slides.
So that's great. So you just call like next slide whenever you want it, and
Yeah,
I'll move on to there.
yeah, and for me, this is the only slide I need up. Actually, so
Perfect.
this slide, and then
What about that one?
Yep, I'll need to basically that'll be the one to have up when I give the rest of my spiel.
Okay, great. So look, you just say next slide and I'll knock it on there. Okay,
Perfect.
that's great.
And then
Perfecto.
perfect. And then Valerie, do you have a work on climate background that I could set as my background?
I don't. You mean like behind you?
Yeah.
Yeah,
You
no,
want me
I
to
don't.
make one very quickly, Jonathan?
Yeah. Otherwise, I could if you've got the ability and capability, I'll would love that. Thank you, Tanya.
Yeah, I punked you guys with my wind farm behind me here.
How long
I
do
need
we
something
have?
better than my office.
You have
How
13 minutes,
Oh
Tanya.
yeah, great. Okay, let me also
No pressure.
in the meantime, can we also just get a quick idea of how many, sorry, is this? Yeah, how many resources or links they might anticipate on the call, something that we need to have ready? Is there something like that, or do you have those things
No,
ready?
so what I've done is I've just sent through the PDF of the deck,
Oh,
and all the links in that are live.
oh,
So I think
fantastic.
the best thing to do is to share that, because I think it also helps people kind of to follow the narrative, like I think the most important thing is like a sequential narrative, because I think it helps people understand why, why people don't understand this. I don't know, but it helps people understand that this is here forever and it's going to shape everything.
Yeah.
Like
And
that's what this is about. Yeah,
and something to think about too is we'll share the deck at the very end in the Slack
sure.
channel to
Great.
drive people there, and we can easily upload it. The time if there's like important links in the deck, you can kind of share them as we're going through. Because
Sure.
the
Yeah.
big two things I think I'm not sure if are in there is one is just a link to sign up for Work on Climate. When we post
Yeah.
that, make sure you post that a couple times. And then as well as there were 2 links that they get for signing up for the actual class if people want to.
Yeah. So I've got QR codes for the certificate programs. And I'll kind of, so I'll put those, you know, we'll have some time for Q&A. You know, this is going to be a massive information download. So I think that's, you know, something that I'll mention to people. It's like, you know, don't get too stuck in the weeds, but if there are questions that people want to post, they can post them in the chat and I'll go through as many of them as possible. But perhaps it's better that people post those questions in the Slack channel and they keep to verbal questions here.
Yeah, we can kind of keep a running list, and that's something depending on if you know, we get to the end of the time, if there's a ton of unanswered questions, because I know the material you're presenting, and people are gonna have a lot of questions
Yeah, it's
on.
gonna be.
So that's maybe something we can always just like keep track of them, or Tanya, if you just want to like copy them and we can just kind of paste them into, and we don't get to them, we can just paste them into the finance community, and Richard can kind of come through and re-answer them later.
Yeah.
Oh, and here's the 2 links for the ESG and the climate certificate.
Thank you for that.
So Richard, since you're sharing your screen, you would be the one to play music. So if there's anything, any music you want
Okay.
to queue up.
Yeah, I was busy trying to see. It looks like you can do it if you're not sharing the screen, but when I try, it doesn't, like it says share screen, advanced tab, but you don't see that if you're not sharing the screen. So I'm not sure.
Oh yeah. Here's a link to it. I was curious.
Yeah, let's see.
I can.
I'm gonna go fill my water bottle. I'll be right back.
Sure. Yeah, I'm not going to win on the music front, I'm afraid.
Yeah, I'm not sweating it. That's the kind of detail. I
Okay,
don't think it's that huge of a deal. We're gonna go
great.
on. And actually, you know what? I didn't mention this to Jonathan, but usually I give like a couple of minutes, like we'll open the room at noon and then I'll just say, you know, welcome to this. We're gonna start in a few minutes.
Perfect.
Yeah, and then you know, I'd say since you have a pretty packed agenda, I'd say maybe 12:03, 12:04, we officially
Perfect.
start.
Yeah, so look, I'll just wait for Jonathan to kick off. But what I'll do is when we're good to go, I'll put myself on mute and, you know, switching off the camera is never a good idea, but, you know, I could do that and then sort of come on just so that, you know, because otherwise people are like, what's that bloke doing there, you know?
Yeah, well, I can spotlight too. I'll spotlight Jonathan when he's talking, and I guess I'll
Great.
remove yours, and then I'll spotlight.
That's great.
Yeah,
Perfect.
I've got that.
Thank you.
Yeah, I'm figuring it out. I'm figuring it out like a big girl.
You're winning, eh?
Shall I share the background on our group, the subco group?
Oh,
Yeah,
sure,
sure.
that's
Yeah.
fine. How do you do that? Well, you're good.
It was a very quick thing I just put together.
Tanya, it's delightful talking to digital natives. Of course, it's just a quick thing you put together.
I know. It's one of the things I'm sure the oldest of the volunteers there, and I'm always pushing back on ageism, but I have to say that sometimes it's like I'm just too exhausted to learn something new. I'm like, I'm not in the mood.
Yeah, no, I feel your pain.
Especially younger millennials and of course Gen Z, they just like take to things so quickly. It's just like, you know,
Yeah,
yeah,
yeah. No, just push buttons and then it works.
yeah,
There we go.
yeah.
If you break it, just restart.
Yeah, yeah. But that being said, wait for their car to break down and, you know, then
Change a tire.
Yeah.
I told my mom, I was like, Mom, just if you click around, you can't really break it. Just like close it and restart it, turn it on, turn it off. And then she like had like 10,000 viruses download to her computer or something crazy like that. I was like, wait, don't click on stuff on the email. She's like, what you told me.
Yeah. There are generational gaps appearing all around us.
Yep.
I'm sadly more on your mum's side of that equation, I suspect.
Jonathan, if you
You might,
want to
you might be
snap,
surprised, Richard. I'm older than
I hope so. I hope so.
you. Can't see the gray beards through the gray and
Yeah.
my beard through the Zoom.
Yeah. No, well, it's a wonderful thing about Zoom, eh? Yeah.
There's lots of layers you can put on and filters to make yourself look better.
Yeah, I need to go discover that. Yeah, perfect.
Auto smoothing and brighten up.
Jonathan, if you want to check Slack, the subco group.
Oh, cool. Did you message me directly or?
I can do that too.
Oh, found it. Perfect. You.
Tanya, do you pronounce your last name Meshram?
Yeah. Yes.
I don't know, Jonathan, if you want to just add that Tanya is assisting as well. You don't, I mean, it's not a huge deal, but
Kanya Meshram.
Meshram,
And
an M, yeah.
can you give me edit abilities for that CFA script?
Oh, sure. I didn't know that it didn't have it. Hold on a second. I will.
Yeah.
Let me get in there. Hold on a second.
Should I also change my name, Valerie, to how you have it?
No,
No? Okay.
I think it's fine. Yeah. Let's see. Hold on a second. Let's see. Share. No,
I
open.
need to invert it.
Yeah, hold on a second. I closed it, so I gotta go in there. Share.
Do you want me to reduce the size of the
Yeah.
okay, because it doesn't look like it's
Yeah, it's
fitting it.
just
Oh, yeah. I think I sent it to your wrong Gmail. Let me do the other one too. You work on climate one. Hold on, Jonathan.
oh, I just have a Gmail. I don't have a
Oh,
work
you
on
don't?
climate.
Okay, good, cool. So you should be able to edit it now.
Oh, I had it for a second. It's a great script, Valley.
Oh, it's a pretty standard issue. Thank you, though. You know what? For future, I don't know if you have this problem, but because I've done a bunch of them now, I got this great app on my desktop called Teleprompter. And so you can put the whole script in there and then like it just comes up. So you're reading it instead of like looking at it because I like have to read things. So it's very
Yeah.
cool. Anybody's looking for something like that, it's very easy to use. It's free. It's awesome.
And it's called script prompter.
It's called Teleprompter.
Teleprompter. Okay,
Teleprompter.
sorry.
Yeah. And you
Okay,
can like change the speed of it. Like if you want to go faster or slower, it's really great.
that's super helpful. Thank you.
Yeah. Jonathan, we were saying, I usually open up the room, like we'll do it at noon, and then you can say, welcome, feel free to introduce yourselves in the Slack, and then say we'll start in about 3 minutes or something like that. So, and we can just sit, around and wait that time.
Perfect. Anybody know any good jokes?
Not much of a joke teller. I'm just funny, just normally funny.
I don't need jokes.
I'm just hilarious.
Yeah, jokes are for boring people.
Actually, the funniest joke to tell is a really unfunny joke, and then
Yeah.
it's like a test of everyone's willingness to be supportive.
Yeah.
Yeah.
How hard did they laugh? I know it's not funny.
Yeah. Thanks for the help. All
Yeah, I appreciate just where it falls flat and it's just like dead silence. Like, well, I guess nobody really likes me.
Jonathan, I've shared another one because I see that this is getting cropped. Maybe this one's a little bit better to your screen
Yeah.
size.
No, I think it was I'll just stick with this one.
Spotlighting you right now, Jonathan,
I saw that.
till we get Richard going.
All right, 1 minute. I'll
Thank
probably
you.
wait I'll probably wait like 30 seconds as people start to fill in the room.
Yeah, that's perfect. And by the way, Richard and Tanya, thank you for burning the midnight oil with us. That's very cool.
It's absolutely no problem.
What time is it where you are, Richard?
It's midnight.
Okay.
So, but I mean, I like to work for US companies, so I'm often, here at midnight. So it's no problem really. And for this, anytime, want to do 3 a.m., I'm good for it. It's just, until we get this moving mainstream velocity, I think,
Yeah, I agree.
Well,
I'm going to open the room.
assuming,
Oh, go ahead.
yeah, I would love to have you back, Richard. So
Yeah. Okay, guys, I'm opening the room, okay?
Do it.
thank you for joining, everyone. We'll be getting ready to go in just a couple minutes. Hello, everybody, and welcome to the ESG Investment Analysis, Drivers and Future Trends workshop hosted by Work on Climate and presented by Richard McGilvery, Senior Director, Product Advocacy and Education, APAC at the CFA Institute, which is the world's largest certification institution for ESG. We will be getting started in just 1 minute once we've given everybody time to dial in. But in the meantime, please feel free to introduce yourself in the chat, your name, where you're dialing in from, LinkedIn, anything else we'd like to hear from you. Richard is calling in from, is it Hong Kong or Singapore? I can't remember. Hong Kong.
Yeah, Hong Kong.
So I'm expecting people from all over the world, which is one of the great things about climate, or maybe the bad things about climate, is it affects us all. And so it takes us all even burning the midnight oil. Richard just told me it's just after midnight there. So we have Berlin, Nigeria. I'm calling from Western Colorado. All right, well, we'll go ahead and get started. I know Richard's got a lot to get through for his deck. So once again, welcome to ESG Investment Analysis, Drivers and Future Trends Workshop. My name is Jonathan Stokely, your host. I am a Founders and Finance Channel subject matter expert for Work on Climate, the event sponsor. I'm also joined by Valerie Vidala and Tanya Meshram, volunteers at Work on Climate, who will be helping to monitor the chat and support on the tech side. Before that, I'd like to quickly tell you a little bit more about Work on Climate. Richard, if you could go to the next slide.
Oops. There we go.
With over 28,000 members and growing, Work on Climate is the world's largest and most active community addressing talent shortages in climate by connecting people through a global Slack community, free climate expert officers, and educational events just like this one. We are on a mission to transform the talent ecosystem and build the workforce humanity needs to solve climate change equitably and justly. Our goal is to make climate work mainstream, empowering hundreds of millions of people globally with the skills and support they need. We need to use their talents to build the climate solutions. If you're not yet a member, I encourage you to join us by visiting our website, workonclimate.org. I'll also throw that in the chat for you. Before I hand it over to speaker, I want to run through today's format events. Richard will be starting with the presentation and talking for about 45 minutes. After presentation will be followed up by Q&A for 15-20 minutes, as long as Richard is willing to hang on. But we will also then take the conversation over to the Work on Climate Learn Finance chat, where we have an AMA for the next 24 to 48 hours, where we can ask any questions and continue up. I've also got several links, and we'll also be sharing the deck with you as well, because there is a lot of information to get through and lots of statistics that are probably going to blow your mind. I know when I first started talking to Richard about this event, some of the statistics about ESG and its impact definitely surprised me. So now it is with great pleasure to introduce our speaker, Richard McGilvray. Floor is yours, Richard. Take it away.
Thanks so much, Jonathan, and thanks to everyone for joining. Thanks to the Work on Climate staff and volunteers. I'm really happy to be here. I think this is the topic for the age, and what I'm hoping to do is give you almost a mass download on why it is that this is sort of front and center of thinking in finance and why it needs to be. I'm going to look at ESG generally, but I'm also going to look specifically at climate. But I'd like, first of all, to sort of explain how it is that we can be in the situation where action is so urgently needed. So before we start, just a couple of things. So obviously ESG and climate are, rapidly evolving field. And that's why it's a great time to be involved in this now. I mean, there isn't one sort of globally established sort of formal way to integrate sustainability issues into finance. So that's very much practice that's developing. And I think the question is like, why should you care and why should we struggle to develop these skills? So I'm going to start off by showing you the World Economic Forum's Global Risk Report, and then they do this wonderful cut of sort of a 2-year to a 10-year time horizon. And if you have a look at the 2-year time horizon, and that's my labeling, not theirs, you can see that the risks facing us as a species, if you like, broken down into that 2-year time horizon look something like that. So you can see it's a mix of social and environmental issues. Misinformation and disinformation, I think, is a critical one. I think we all understand that and how it drives social polarization, cyber insecurity, armed conflict, lack of economic opportunity, inflation is very much in sort of many news flows at the moment, involuntary migration, which is directly related to sustainability and many issues, et cetera, et cetera. So you see that there's this mix of social and environmental issues. And if we push that out to the 10-year time horizon, what you can see is those environmental issues really sort of rising to the fore, and climate in particular, but critical changes to Earth systems, biodiversity, and the likes. So that's the risk environment that we are operating in. And if for a second you imagine that you were a responsible government and you were concerned about the well-being of your population, what would you do confronted with a risk sort of landscape like this? And the answer is that governments have almost universally focused on the environmental and particularly on the climate-related issues because they're so sort of central to so many of the other issues. And so what you have are these national net zero commitments. Late 2023, they looked something like that. So you can see the vast majority of countries have some kind of a commitment to net zero. And that means they have some kind of a commitment to cutting emissions significantly. And, you know, there are a couple of countries that don't have net zero targets. Just to be clear, there are some countries that are already at net zero. They're small, and you can look up the list of names because I think it's quite interesting. So that's the first thing that governments do, is they make these commitments, understanding the risks that they pose to their populations and to the global economy and the like. And if you're a government and you're going to make this kind of commitment, you need to sort of follow that up with regulation that sort of drives compliance, if you like, or helps achieve the goals that you're reaching. So if you kind of, this is a graph that comes from the PRI database, but it just shows it's the shape of the graph that I'm interested in. You can see this very, very rapid increase in regulations, and there are just a couple down the side that I think are worth calling out. So SFDR, which is the European Green Deal, and that has a very specific agenda to drive capital towards sustainable ends. And it's highly influential around the world. So for example, CBAM, the Carbon Border Adjustment Mechanism, which is essentially an emissions pricing mechanism in Europe, is going to impact people who trade with Europe. So these might be standards issued in particular countries, but they often have sort of supranational impacts. CSRD, we're going to touch on in a few slides later. And then I just also wanted to flag for people TNFD, the Task Force on Nature-Related Financial Disclosures. TCFD is really what kind of drove thinking about emissions and emissions pricing. And I expect that TNFD will have a significant impact too. So I'd encourage people to keep an eye on that. Now, the next slide I put in quite late, so I don't think our colleagues at Work on Climate have seen it, but I just, you know, I'm not going to talk to this, but just take the time afterwards when you're having a look at the deck, because, you know, I think sustainability is to some extent an alphabet soup, but some of that alphabet is really important and I think really worth paying attention to. And this slide kind of provides quite an effective summary of really influential standards, regulations, and the like. So I'd encourage you to sort of at least understand the latter parts of that kind of timeline, and in particular, the relationship between many of the things on that timeline and the ISSB S1 and S2 disclosures, so which is kind of described in the bottom half of that. Now, so you ask yourself, well, what really are regulators trying to achieve with this sort of release of regulation? And in essence, they're trying to do two things. Okay, so firstly, they're trying to address climate risk from a physical impact perspective. And then they secondly are trying to manage the impact of transition. So sort of at a portfolio level, I've seen some examples where transition risk is 4,000 times greater than physical risk. From an investment perspective, that's because you can diversify away from physical risk for the time being. But transition risk, as we'll see later, affects the whole of the economy. So regulators are really trying to manage these two issues. And how they're trying to do that, and what are many of these regulations driving at? They're trying to improve the function of capital markets. In some jurisdictions, they're trying to direct capital towards sustainable ends, and I mentioned that in Europe under SFDR. They're obviously trying to improve disclosures, and disclosures are really important to understanding the impact of sustainability issues on value and the performance of assets. They're also keen to protect those capital markets and investors by controlling around greenwashing. So what it is, you know, how do you know something that claims to be green is green? And that is increasingly being managed by regulation. Now, What about asset owners and investment managers, which is the industry that I work in? And what you can see here, and these are PRI signatories. On the next slide, I'm going to show you what commitments PRI signatories are making. A couple of things that are really interesting about what you can see in front of you. So firstly, the shape of the graph and how that sort of echoes, if you like, the regulatory shape of the graph. But on the left-hand side of that graph, you can see that these asset owners and asset managers collectively account for around $140 trillion of assets, okay, which is not far off total global market capitalization. So if you're going to be working in finance, it doesn't matter what jurisdiction you're in, these issues, because of materiality, and I'm going to talk about what that is, are increasingly important and relevant. So just, I think there's a missing link there. So those are the August 2023 numbers. I just like the shape of that graph, which went up to 2021. You can see that this graph, that these numbers have now reached 5,300 plus signatories, of which 1,008 are in the US. And the reason I mention that is because I think there's a view that the US is in some way anti-sustainability. And I think there may be a political narrative like that. But you know, if you actually look at what companies are doing and how, you know, work that's being undertaken, energy mix, for example, you can see that there is plenty happening around the world. Okay, so now I said I'd show you what the commitments that those PRI signatories make. So principle one, we'll incorporate ESG issues into our investment analysis. And I know ESG is not a popular three-letter acronym in the US, but we'll incorporate sustainability related issues, both environmental, social, and governance related, into our investment analysis. They're also making a commitment to be active owners. So if you're holding shares in a company, and particularly if you're a significant shareholder, then you'll be engaging that company's leadership in order to improve their sustainability practices. Now you've got to ask yourself again the question, why is that? And we're going to discuss that in detail. And then in order to achieve 1 and 2, you're also going to seek appropriate disclosures from those companies on sustainability related issues. Now, again, legislation is increasingly stepping into that space. And so hopefully with ISSB S1 and S2 disclosures, that information becomes much more readily available. But these asset managers and asset owners are agreeing to those 6 key principles. And again, if you're thinking of working in finance, and if you have a look at the incredible number of organizations supporting those PRI sort of undertakings, it starts to become evident that these are skills that are increasingly important to people. Right. So what are the asset owners and asset managers trying to achieve? And this is really important. This isn't necessarily a political agenda. It may be in some instances, but primarily what they're trying to do is they're trying to understand and price the full range of risks and opportunities in relation to sustainability issues. And the reason that they are keen to do that is because they have a fiduciary duty to safeguard and grow the assets that they are looking after. So key to that is they want to understand these risks and opportunities, and then they want to understand materiality. So the financial impact of these issues on the value and performance of assets is referred to as materiality. And we know that sound sustainability practices are material for companies. In other words, they matter in terms of how those companies perform. So the question you ask is, well, how do we know that? All right. So I think that I'm going to start just very quickly. I'm going to jump forward 2 slides here. So there's this Oxford University study, which was 2015, and that's like suddenly nearly 10 years ago. But these are the key findings, and please bear in mind that this is a study of studies, all right? So it looks at over 200 other academic studies and sort of, synthesizes those results, and those are 3 kind of key findings. Now, that's quite dated at this point. So much more recently, NYU Stern and Rockefeller Asset Management undertook a similar but much wider undertaking. So they looked at over 1,000 studies, and particularly looking at studies that were published after the Oxford University meta study, and they had similar findings, perhaps not as striking in terms of material impact, but you can see a positive relationship between ESG and financial performance for 58% of the corporate studies. And then a couple of other nuances that I wanted to touch on. Improved financial performance as a result of kind of managing these issues successfully tends to take place over longer time horizons. So, if you kind of a day trader, then these issues perhaps don't matter in the buying and selling of a stock in a very short period of time. But for the long-term management of companies, these issues are material and relevant. They think that, well, their study found that one of the key drivers of that impact was improved risk management and innovation. So that theme of risk comes through quite strongly. And also that managing for a low carbon future, and that's where you start feeling this transition issue coming in, like how the economy is going to change, improves financial performance. And then that critical last point, which I think is so important, is that disclosure on its own does not drive financial performance. So disclosure needs to be followed up by actions taken by companies. All right. So this isn't about just, this is where we're at. This is about, this is what we're going to do about it. And I think, so that's how we know, first and foremost, how these issues are material. Now I'm going to go back a slide because single and double materiality, I think, are also very important to understand. So single materiality, which is probably more commonly referred to as financial materiality, what that looks at, so that asks the question, what impact does the wider environment, and that I mean environment in the environmental sense, but the wider sort of environment surrounding a company, how do sustainability issues in that wider environment impact the company? So that's financial materiality. So if the sea level rises and, you know, I own coastal resorts, how does that impact the value and performance of my company? Now, the reason it's important to note financial materiality or the single materiality is because ISSB disclosures focus on single materiality. Okay, so that's one way of looking at things. Now, there are other ways to look at things, and you know, so you can also look at environmental and social materiality, which is the impact that the company has on the wider operating environment, which is kind of, in a way, slightly more logical way to think about pollution, which is ultimately what emissions is about. So if I have a factory and I pump a whole lot of waste into a river, that can have an impact on all other people, you know, reliant on that river. So you'd expect there to be some negative impact on that business. Now, environmental and social materiality, or this double materiality, is also called impact materiality. And I think that's probably a better term because it's how a business impacts the environment in that direction. Now, I mentioned CSRD, okay, which is significant European legislation that has really come into effect this year. And some of the additional requirements under CSRD in Europe, the first one on that list is double materiality. So interest in companies disclosing the impact that their operations have on the wider environment. So I just thought that's an interesting kind of space to watch. We've got financial materiality only in many markets, and in the case of Europe, we've got impact materiality as well. Now, how else do we know? I mean, I've showed you some pretty dated stuff. So this comes from August 2024, this month, and here's some examples. So the European Central Bank, the Dutch National Bank did these studies, and two of the things that they noticed is that 25%, or the top 25% of carbon emitters, okay, in Europe, are being charged interest rates that are on average 14 basis points than the lowest 25% of emitters. So you can start to see like that value impact, if you like, of emissions in this example, and a similar finding by the Dutch National Bank. Now, you might question those numbers and think, well, does that amount to a very significant impact? The answer is it depends on how deals are structured. It can be quite a significant impact, but the point is that this is really kind of showing up now as real issues that affect businesses. So, and that is really the core of what materiality is about. There's financial impact on business practices. Now, given that environment where we understand these risks, we can see governments motivated and moving, we can see regulation supporting that, what are the barriers to us achieving improved sustainability? And mentioned right up front by Jonathan, and very much the focus of work on climate, something that I hugely applaud, is there's a very significant shortage of skills in this space. Now, remember, of course, that it's a new field as well, all right? So that obviously also has an impact. Now, this is a study we did using LinkedIn Analytics in 2020. So it's like, it's nearly half a decade old. And at that time, All right. I think sort of at the very early stages of sustainability being mainstream, what we found, and we looked at over 1 million profiles in this, so it's significant data set, is that there was roughly 10 times the demand for sustainability skills than there was the supply at that time. And that is not something that's changed. I think this is very much a gap that is widened further. And if we have a look, doesn't matter which market you're in, and there were some, notes right at the front in Jonathan's slides, doesn't matter which market, there's just this continual theme of there's a shortage of skills. Now, this doesn't mean that if you skill yourself in sustainability that you are automatically employable, okay? Employment tends to be much more complex than that. But I think at this point in time, these are skills that are very valuable for career advancement, if that matters to people, for all the reasons that I've set out. And at some later point, when I think this is firmly entrenched and mainstream, then it will be a risk not to have the skills. So I think it's worth thinking about it in those two terms, but certainly that is a significant barrier. What this slide does is I'm just going to show you the levels of complexity, because if you're thinking about the shortage of skills, it's also worthwhile thinking about what kind of people play what kind of roles. And so this comes from Harvest Fund. It's a $200 billion fund, and looks at their ESG research framework. And if I just go through it, you can see they've got these sort of subcategories. I hope people can see the tiny writing. It was just no way to make this bigger. So if we have a look down there, you can see on the environmental side, there's sort of biodiversity, water stress, green procurement, end-of-life product management. They're very, very significant kind of areas of focus in their research. And if you think about what kinds of people can perform that research on behalf of the organization, it's an incredibly broad skill set. In the social space as well, you can see and really materiality in the social pillar is really about relationships with stakeholders and impact on stakeholders. And you can see some of that showing up there: product affordability, community development, employee benefits, labor controversies, and the likes. And then, of course, governance, which is actually a well-established field of thinking about how companies perform. I'm not going to go into that, but you can see just the complexity of this suddenly. Suddenly in finance, there are roles for people with non-financial backgrounds. So I was talking to someone who's the head of the social pillar in a Singapore business, one of the big four accounting and consulting firms. He has a PhD in sociology. So just to illustrate how significant this is really kind of a bringing together of skills around this common purpose. Now, what about on the investment manager side? Like, how are investment managers trying to deal with sustainability issues or reflect sustainability issues at a portfolio level? And so what I've done here is I've just tried to create like sort of 6 simple boxes just to talk you through what this looks like. So first and foremost, there's exclusion. Used to be the most widely practiced, is quite rapidly falling out of favor. But essentially, this is where asset owners and asset managers say, we won't invest in companies that are, for example, significant emitters, or invest in companies that have significant social controversies. So that is, a very common practice. It is the oldest form of managing sustainability issues. Actually goes back to the 1750s with the Quakers, who banned their members from profiting in trade in guns and slaves. So exclusion has that length of history. ESG integration, which is about doing traditional financial analysis, but considering sustainability issues at each step of the way. And I've got another slide that will just break that down. Now, that is now the most widely practiced way of, integrating sustainability issues into financial thinking. And it's closely aligned to corporate engagement. You can see, again, going back to those commitments that the PRI signatories make, corporate engagement is an increasingly important part of finance. So how you encourage your investee companies to improve their sustainability practices. And in fact, it's one of the most material approaches. So I'd say that is kind of, I'm simplifying it enormously, but broadly, that's the mainstream approach, if you like. So exclusion, ESG integration, and stewardship and engagement. Now, on the more specialized side, and you're seeing mainstreaming happening in this space, The next one is positive screening. Negative screening is exclusion. Positive screening is best in class. So that what investment managers don't like about exclusion is it narrows the investment horizon. Now, what a best-in-class investor is free to do is invest across all asset classes. So it could be, fossil fuel energy producers, for example. But what these investors are looking for is the top performers in each of those sectors on sustainability issues. So again, you can see a reward of capital and other things, sort of starting to reward, top quality behavior in sectors. Thematic investing, that is very much the opportunity side of sustainability. So electric vehicles, sustainable food, human development, energy transition, etc. Again, rapidly growing in popularity and in interest as people kind of really understand those challenges that we set out right at the beginning and how governments are responding to them. And then the final category I've included is impact investing. Impact investing, investors are typically willing to surrender some of their returns in order to achieve a particular impact. So you're investing in a certain way and you want the financial return, but you also want some other sustainability related returns. So impact investors are also kind of collecting and measuring impact data because that forms part of their reporting. So that kind of at a high level is what sort of the investment world looks like. Now, I mentioned, now it's important to say that European data is not included in this, but you can see here that this kind of growth in ESG integration and corporate engagement and shareholder action. What's interesting about that is that you, in essence, you need to have the understanding that ESG integration gives you in order to engage corporates. And really the reason that corporate shareholder engagement and shareholder action is so much more widely practiced is also because of the proxy voting firms. So if you're interested in that, go and have a look at ISS and Glass Lewis. They are proxy voting firms that are operating around the world representing shareholders. And what they do is they publish their sustainability objectives each year. So that's what they'll be engaging companies on. Very widely used, very influential. Now, I mentioned I talk a little bit about ESG integration. Just going to touch on this, a couple of examples. So in traditional financial analysis, you'd be forecasting financials and ratios. If you're going to do ESG integration, you'd do that traditional work, but you'd make adjustments to margin, sales, etc. So for example, if you were an automobile manufacturer and you produced the most petrol, gas hungry car you could imagine, with the emissions focus that we have increasingly worldwide, that would have an impact on your sales, your margins, etc. So it's kind of quite logical how these things play out. And what you're seeing here is materiality being taken into account in essence. We construct DCF models, discounted cash flow models in traditional finance. And here you might adjust the hurdle rate through consideration of sustainability issues, etc., etc. So you can see that if you want to get into the ESG integration space, you need this combination of traditional financial skills as well as an understanding of sustainability issues so that you can integrate at each of those steps. Now, in reality, investors are using combinations of these approaches. So what I thought I'd just show you is this comes from APG, the Dutch sovereign employees pension fund, a very significant asset owner and a leader in sustainability thinking. So what they've done is they've got this investment process. So they're looking at investments and they are categorizing them into leaders, laggards, and an exclusion list. So really you can see a couple of those approaches there, best in class at the top, and an exclusion list at the bottom. And then what they're doing is they're then doing their traditional financial analysis. And if they find the risk return analysis attractive, then they will invest in the company. I'll just put that up. If it's unattractive, then that company will go into their watch list. So not invested and not excluded. Similarly with laggards, if they feel that a company has potential but is not, meeting its sustainability objectives, they might consider putting that into their promises bucket and seeing it as a target for corporate engagement. So again, I'm just trying to show that an interchange of these methodologies, if you like, it's certainly at an asset owner level. So it's quite interesting how they might function collectively rather than discretely. Now, I'm going to stop here, okay? And I'm going to just ask you to kind of take a pause in your mind. And we just want to shift now to focus a bit more specifically on climate for the next sort of 10 minutes or so. And I'm going to start off by just giving you this very quick lesson. And, I'll ask you a question. You can post answers in the chat along with any questions that you have. So here's some plant science for you. All right. So as carbon dioxide concentrations in the atmosphere have increased, the planet's warmed. That's what we're doing here today, as we're talking about climate change. But as a result of those two issues, as of today, plants are in fact growing faster. Okay, they need CO2, and generally speaking, they appreciate some level of warmth. But we've got this problem that when the temperature increases too much, okay, then plants start losing moisture from their leaves, and damage happens. Enzymes, which are proteins based, are damaged, and those enzymes are critical to photosynthesis. And so what the plant does is to stop that water loss, the stomata, the pores in the bottom of the leaves, don't open so much. So this reduces the loss of moisture, but it also reduces the amount of CO2 that the plant can take in. And the damaged enzymes in that plant also impact the amount of CO2 that can be absorbed. So what happens then? Okay, so some plant species die off, and the remaining plants, for these reasons, absorb less carbon dioxide. And then after that, that causes a further rise in CO2 concentrations in the atmosphere, which causes further warming, which leads to more plant species dying out, etc. So the question I have for you is, what is this an example of, and what is the bigger message? All right, so it's a rhetorical question. So I'll give you a chance to think about it. But in essence, this is called a negative feedback loop. And it's an example of one of the potential climate tipping points that we face. Okay, so once you get down into the center of that circle, there's no coming back, all right? Because your climate has changed to such an extent that evolutionary processes cannot keep pace with them. All right, so that's a tipping point, negative feedback loop and a tipping point, and I'm going to talk about a few others. So before we get into that, I think one of the most important things to understand about climate is the notion of an externality. All right, so an externality, a negative externality in this instance, is a cost that I impose on you, even though you're not part of my transaction. All right, so let's say I buy a nice big car with a big engine, and I drive it around Hong Kong, and I emit CO2. It takes between 7 and 14 days for that carbon dioxide to circulate the earth. So just the comment earlier that this is a collective undertaking, nothing could be truer. Climate is absolutely collective. So if I do that, and then sea levels rise in the Seychelles and impact communities there, I'm imposing a cost on the Seychelles through an action that I'm taking. So that's an example of a negative externality. Now, a core understanding that is worth having is, what are these greenhouse gases that really kind of form a core part of those negative externalities? Carbon dioxide, we mention all the time. Methane, or methane for some people, is a significant challenge in itself. All right, it has 96 times the global warming potential of carbon dioxide across a 20-year period. So understanding what those greenhouse gases are is really important. And then what we've done is we've created this measure called CO2e, carbon dioxide equivalent. So you can talk about methane using CO2e because we're interested in this global warming potential. So that's a key understanding that's worth having. Now, how do you bring these two things together? All right, now, if we stop for a second and just say, okay, what are the drivers of portfolio thinking and investment management thinking? So we've got these physical risks and these tipping points, which I would describe as known unknowns. We know they exist. We know there are many of them. We don't know exactly when they kick in, but we do know they're irreversible. Okay, so the scientific community is really kind of driving that understanding. We've talked about governments and regulators. We've also seen asset owner allocations. So you saw APGs in that case. Asset owners are increasingly focused on this. There are also changes in investor perception. And I've got a great figure from Thailand, which I'll show you a bit later. And then, of course, the opportunity side. All right. So the transition from a high carbon to a low carbon economy, as much of it as it is as a risk, is also kind of potentially the economic opportunity of a lifetime. And then if we have a look at this, what are the challenges facing the finance industry in particular? I've mentioned many of them, but I think one that I want to kind of touch on is that historic short-termism. And we've seen how these issues play out over time. We've seen how the tipping points play out over time. We've seen how company performance is positively impacted by sound sustainability practices over time. So really thinking about those time horizons is really kind of critical and important. Now, getting into physical risks, I think physical risks are really important to understand, and there are a lot of adjectives on the left-hand side of the screen. They're diverse. Okay, so physical risks absolutely everywhere. They are increasing. We know that is the case, and they are geographically specific. So what impacts you in the market that you live in is different to what impacts me in the market that I'm living in. And then the other two, that they are non-stationary and non-linear. And I just want to kind of touch on these 2 points. But here's an example using flood damage, for example. So if you have a look at floodwater impacts on a UK train station, you can see that, you know, flood depth of up to 2 meters is manageable in terms of the asset impact, okay? And then you get this incredible acceleration, somewhere between 2.5 and 3 meters of flood water, and where it just essentially accelerates up to the point at which the train station is no longer operable. So you can see that's a great example of sort of non-linear impact. And another one on the right-hand side, and I thought it would be useful to use this as an example because of my tipping point example. You can see that, like, you know, at some point it's too hot for corn to grow, but it benefits from that increase in temperature. And that is another example of non-linear impact. So it's incredibly important to understand that, like, these are some of the challenges that we face. It just isn't an easy rule of thumb of this equals that. And that really is what I think presents a real challenge to finance in many industries. Now, transition I've mentioned. So let's talk a little bit about what those transition risks are, and I'm going to show you some examples. You can see there's sort of a hint of something to come. So firstly, policy risks, and then we've seen that increase in policy action, and that presents real issues for investors because you might be holding an asset that is negatively impacted by a policy being introduced. So policy risk is key in transition. Market risks really focus on consumer behavior. Legal and reputational risks and technology risks are all issues that investors have to wrestle with, finance people have to wrestle with. And here are some kind of examples of it. Okay, I mentioned CBAM earlier, the carbon border adjustment mechanism. So that's come into effect. If you're trading with Europe, if you're part of European supply chain, many countries in my region are part of European supply chain. I'm originally from Africa, so that's true for Africa as well. That reporting came into effect last year, and the actual pricing of CBAM, where essentially Europe is going to charge you on imports the difference between their carbon price and the carbon price in your domestic market. All right, so that's a very significant impact for a company if you're in that supply chain. Market risks. I mentioned that I had some interesting information from Thai consumers, and this comes from the Visa company. 43% of Thai consumers are taking brands to minimize their impact. 48% look for brands focused on sustainability. And then the part that I find really interesting, 23% are willing to pay a bit more to support companies that have sound sustainability practices. So you can see that this mainstreaming is really kind of starting to come into force from all these different angles. Legal and reputational risks, I just wanted to show you the, just the kind of the increase in both the number of liability cases that are sustainability related, but also the increase in the number of markets in which that is taking place. And then finally, technology risk, another of the challenges. So for example, solar costs, what you won't be able to see there, but essentially the top line was the 2010 forecast. The line below that was NAM's 2011 forecast and the price of solar in terms of its energy production capability. And then you can see the actual price of solar below that. So this is a very, very tough market to predict. Okay, and that of course presents challenges for finance, and part of the reason why there's such a demand for skills and diversity of skills in that. Other examples, stranded assets are increasingly becoming a challenge, and there are two examples that I've taken, essentially the same example. The numbers are even the same. So in Australia, probably unsurprisingly, because there is a fair deal of climate action in Australia. In Australia, largest coal-fired power station, retired 7 years ahead of schedule. So if you're holding that asset, that's an example of a transition risk. But similarly in Indonesia, okay, a country that is, sort of, I think, still very focused on how it's going to transition away from coal, you can see this kind of action is taking place as well. Now, I'm not going to get into this in any great detail, but if you want to understand climate and emissions, you need to understand the different scopes. So I think that won't come as a surprise to many people on the call, but if you're new to this, you can see those greenhouse gases that I mentioned at the top, CO2es. Scope 1 is your direct emissions from your company. Scope 2 are your indirect emissions, principally related to purchased electricity, and scope 3 are the emissions from your supply chains. Now, those emissions in the supply chain, scope 3 emissions are typically 7 times the size of scope 1 and 2 emissions, so they really matter. But scope 3 emissions are not required under ISSB at this point in time. So understand that those regulations have vulnerabilities. Right, so here we go, okay, 1.1 degrees, that's where we are at the moment. The world's heated up to that point and more, all of it down to human behavior. You can see just examples of physical risk impact. You can see that there. The question of what about the tipping points that I've mentioned? And then the part that I think is really kind of telling is that our unrealized policy positions, in other words, where our policies are currently that haven't necessarily been realized, puts us on track for a 2.9 degrees increase in temperature, which is very significant. And you can see some of those physical impact risks, and I call out in particular 170 million climate migrants or climate refugees. Currently, that number is about 25 million. 14% reduction in the global GDP. That's the cost of not addressing these issues. Now, we do understand the global carbon budget, and I think there's some figures there. So carbon dioxide that isn't absorbed is with us for between 300 and 1,000 years. Methane, by comparison, is around for 16 years, 1/6. Okay, so the carbon dioxide excesses that we're living with now literally go back to the Industrial Revolution, 1850, and we've talked about those physical risks, but then the transition risks are the real challenges from finance people. And I'll let you sort of cast your eyes over those. But really the key question is that bottom one, is how will a shift to a low carbon economy, how will that affect business performance, and what will happen on the journey between A and B? So you can see the physical risks there and the transition risks there. Now I'm going to sort of wrap up by whizzing through this quite quickly. So those are the net additional emissions that we face. Okay, there's 1850. And the next slide I'm going to show you is going to be this green box. Okay, there's 2050. Those are the net zero commitments. That's where we are now. And so the question is, how much and how fast do we have to cut emissions by? And with scenario analysis, that is going to help us understand that. So if you have a look there, so this is the green box, okay, without the line that led into it. And if you ask, if we're going to achieve net zero by 2050, how much do we need to cut our emissions by? And, please do go have a look at the links and do have a look at the IPCC in particular. I think a great source of science. But that's the remaining carbon budget between now and 2050. Now, I'm not going to try and quantify it here, but I can just tell you now that triangle is smaller than the area to its left, labeled historical. So that's how aggressive our emissions curtailment is going to have to be if we want to avoid those physical risks and we want to avoid those tipping points. So that is the challenge of transition, if you like. How do we assign values to emissions? So again, something that I encourage you to go and have a look at. Carbon taxes are one example. CBAM is an example of a carbon tax. There are also compliance and voluntary markets. That makes for some quite tawdry reading in many respects, but do go and understand how it is that emissions are being priced. This is how they affect finance. So, for example, if you take the carbon price and you take the carbon budget, so you use a climate scenario to work out how much a company should be emitting by a certain point in time. And then what you do is you take the carbon price and you apply it to their excess emissions. And then you apply that to your valuation, and you can see essentially it's an additional cost, if you like. All right. So if you take that and add that to your valuation, you can see that the company valuation shrunk significantly. And I have a great number of slides to share with you, but there isn't time for that today. But think about the implications of that for finance. Okay, emissions are increasingly being priced. Europe will impose pricing on people through CBAM, and this is the likely impact on the value and performance of organizations. And this is just looking at emissions alone. I've got a little bit of homework for you. So one of the things that I thought would be worth your while is, if you're new to this, I would go and have a look at all of these new metrics, if you like, on the left-hand side, and understand how those are showing up in valuation. So what I kind of created was a grid that you can sort of look up and fill out those answers yourself, because I don't think you'll see them on the PDF, which is great. And then they all have increasingly these numbers of transition metrics. Okay. And again, I've provided definitions here, but I'd like you to go and have a look at those, because I think they're increasingly important, and these are increasingly metrics that finance people are having a look at. Now, very briefly, because I'm also here to answer questions about our ESG certificate and our climate certificate, I think it's just important to understand how CFA Institute builds its program. So we have around 200,000 members, people in the investment management industry globally. We run a process called Global Practice Analysis, which is a year-round practice where we speak to investment professionals, not only CFA chart holders, all investment professionals, regulators, universities where there's great thinking, and other member associations. And what we try and understand is, what are the current industry trends and what are the skills and knowledge that people need to perform in that environment? And from that, we create our programs in terms of their learning outcome statements. And that's an extremely expensive and tough process to replicate. All right. So I would say that is probably our greatest advantage, is that process of kind of gathering understanding. So when we launched our ESG certificate, and then when we globalized our ESG certificate, these are the people that we originally intended it for: portfolio managers, analysts, fund managers, relationship managers, product development teams, wealth managers, strategists, and consultants. So that was who we had in mind, and who we consulted around. Now, those people are among the 50,000 people who are engaged with this program. But what we found, to our surprise, but it kind of illustrates this, this is really the work of everyone as it goes forward in this mainstream: investment advisory, ratings agencies, PR, corporate communication, regulators, etc. So it is an all industry undertaking, if you like, and because transition affects all of industry, and in the near term, I think that has also kind of driven things forward. Now, I'm not going to go through this in detail, but just to say, as you'd expect, there's an overview to ESG investing. There's an understanding of drivers of the ESG market, some of which you've seen today. And then, as you'd expect, we look at environmental, social, and governance factors. We also look at engagement and stewardship. You can understand how important that is, given how popular that approach is. And then we look at ESG analysis, valuation, and integration, which is probably the bulk of that program. And then also the impact on portfolio construction and portfolio management. So it is a very, very comprehensive certificate. And if I had to kind of explain it in educational terms, it builds this foundation, a broad and effective foundation. And the thing about foundations is that you can build vertical specialization off them. So it's much like, building a building. Solid foundation leads to durability. and our climate risk valuation and investing certificate, which is at a more sophisticated level, if you like. You need to be able to do valuation, for example, to undertake that, or be willing to learn it in short order. So that is an example of a vertical. So the certificate in ESG investing really covers it all. Then climate gets quite specific. I'm going to pause there. I've gone on for longer than I intended. So what I'm going to do is, I'm going to leave those up on the screen for the time being. I can see that people have introduced themselves. It's wonderful, and it's great to have people from so many markets, but I'm very happy to ask people if they'd like to unmute themselves and ask a question. And I see there is a question here. I just worry that I leave some questions out. If we need to move, okay, so here's a question, and thank you, Aditya. If we need to move away from fossil fuels as fast as possible, and is this compatible with a best-in-class portfolio, which also has oil and gas? It's a great question, and I think your question answers itself. So no. I think that if one envisages a world where there are no fossil fuels, then that clearly wouldn't be compatible. But at the same time, we've got to get from here to there. And so I think in that context, I think this is perhaps understandable. But I think, Aditya, you've hit the nail on the head. There are limitations to all these approaches. I believe Hong Kong citizens get a subsidy if they pursue the certification. Yeah, so in several markets, and I think that one of the things I'll say about Asia is that sustainability is very, very much a hot focus here. And please bear in mind that 62% of the world's population lives in the Asia Pacific region. Okay, so again, going back to that first slide, if you're a government and you're worrying about people, this is like right up there on your list of worries. So the Hong Kong government, in terms of just trying to address the shortage of sustainability skills, is funding sustainability learning. Our certificate is one of the certificates that they fund, but there are others. Similarly, in Singapore, there's a similar sort of approach undertaken by the government to support learning that is necessary for these economies, and these economies understand that transition is critical. And yes, thank you. Lauren posted a very helpful note there. So check this in your market, because it's not true only for Hong Kong, and I mentioned Singapore. There are others as well. Great. I'm just scanning down for any questions. It's a pleasure, Anisha. Thank you. Feel free to unmute yourselves. We've got some time. Let's go for it.
Yeah, if anybody has any questions, feel free to come out and ask, or raise your hand if you'd like.
Could you recommend specific mutual funds in, say, the European market in which to invest? The most effective ones, exclusionary, best in class, that also weed out greenwashing companies. Aditya, thank you for the question. I couldn't recommend mutual funds in Europe, and I'd, if I did, I hope you would disregard any advice that I gave. So I think a way to think about this, another way to think about this, is how do you determine whether it's kind of safe to invest in a fund from a sustainability perspective. So the European legislation that's outlined, Article 8 and 9 funds, I think are, these are well-regulated markets, and I think that one could have a look for Article 8 and 9 funds, and I think that you could be pretty confident that those were genuine rather than sort of greenwashing. So let me park it there. Oh, thanks, Laveen. Any other questions? Let's go.
I've got one I was curious about. There's a
Sure.
huge lawsuit that was brought up about how BlackRock was accused of defrauding their investors for their ESG initiatives and some of their funds. Could you speak to that for a second?
Yeah, I can't speak with any sort of detailed knowledge. So let me first of all say that I think the sort of the politicization of sustainability in the US has driven a range of interesting outcomes. So I know that BlackRock, just from following similar news flow, has been on the receiving end of both of those. All right, so objections from some of their clients that they integrating sustainability issues on the one hand, and then, you know, accusations of not doing that adequately on the other. So I think that, you know, I wouldn't want to comment about, you know, an external company, but I think that if you find yourself in the middle of two kind of opposing camps on a political spectrum, and they're both having a go at you, probably the greatest insight that you can glean from that is that it's a very tough tightrope to walk. You know, to, you know, sort of supporting, trying to manage both of those perspectives.
Thank you. And Richard, before we go on, would you mind switching to the next slide?
Sure. Forgive me. Yeah.
People have
There
to
we
drop
go.
out. If we'll keep up with the questions while people are here.
Yeah, great.
Work on climate. Please take a second to give us your feedback. If you found anything of value that we talked about today, we'd love to hear it from you. You know, Work on Climate is a community of volunteers, and as such, we're a nonprofit and rely on nonprofit funds. So your support, feedback, valued is great for helping us continue on with our mission and having great speakers like Richard here today. So just take a please minute and scan the QR and go with their feedback. And we'll also be holding the AMA if we don't get to your questions in the Learn Finance Slack channel for the next 24 to 48 hours, as well as posting the deck and recording of the video. So with that being said, go over to the Slack channel if we don't get to you. But on that, Richard, we've got some more questions. I think someone even raised their hand. Zoom user, if you want to go ahead.
Great. Okay. Well, let's go with the raised hand first. So whoever's hands raised, I can see you.
Yeah. Hey, thanks, Richard. Really appreciate your talk here. Very informative. So in terms of yeah, just you know, you kind of, this is a lot of information. I'll have to revisit your recording and, you know, go through the slides one more time. But just as a kind of like a quick takeaway, what would you say is like the three most pressing thing that we should kind of think about as a in the financial industry, and then maybe some like mid to long term kind of three things that we kind of look forward to. Thank you.
Great. Okay. Yeah. Okay. So tough. Great question, and you know, challenging. So I'd say the first thing that we have to be conscious of is just transition. Okay. So the finance sector, you know, focusing on transition, I think, or not focusing on transition, I think could catch a lot of people asleep at the wheel, because I think these changes happen really quickly, and because transition can be, you know, driven particularly by regulation, there isn't necessarily visibility into that happening. So I would say that's the first thing. The second thing is understanding materiality and what is material for the particular company that you're looking at. I think that's difficult to ascertain. So for example, if you go to SASB, you can use the SASB materiality maps. I think that's a helpful information source. But sort of staying on top of kind of regulations globally, I think, is very tough. And as we've seen, like, regulations in one market can affect another. So understanding materiality and sort of being comfortable with that, I think, is you know, for a specific company in a specific market, I think is particularly important and challenging. So I would say those are the kind of the two that that really kind of strike me: transition on the one hand, and, you know, what materiality looks like on transition in the other. So that was the first one. And your second question, could you repeat that? Because I was so kind of trying to work out the first one, and I only gave you two. Forgive me for that. You had a second question also with
please,
a ranked list.
That was wonderful. Thank you, Richard. I'm just kind of looking at, so those are kind of like the short-term things to look out for. But what are some of the long-term, mid to long-term things that we should kind of look out for that's out in the distance, but you know, it should be kind of in our back of our minds?
Yeah, I think look, this is a personal opinion, all right, and I work in this space, so I'm influenced by it. I cannot imagine even a reasonably near-term future world where these aren't central considerations. So I think that's, you know, really the issue. And the question is, like, if these are central considerations for all societies, then how do we manage that, and how do we manage just transition in particular? So if I think about emerging market economies and frontier market economies, and you know, just the huge numbers of people living in those economies, it's kind of it's a real challenge to understand how suddenly those economies are not going to you know, have the fossil fuel acceleration that has kind of driven development in other economies. So I think that's an interesting question. And then, you know, how effective are we at restructuring electricity grids and dealing with renewables effectively, I think, is the other kind of key question. So I think a lot depends on that, because, you know, so I think that the emerging markets now account for 70% of global emissions. I think that's the right number. So the important thing to get right in that is for wealthy nations to understand that, like, I'm not sure if there's really an option. Okay, they're like, just transition needs to happen, and transition in countries without resources needs to happen, and that means that funding has to come from somewhere. So I think, excuse me, I think that's the long-term challenge, you know. So, you know, and as I say, that's not a statement of equality that I'm making. You know, it may also be a statement of equality, but that's not my intention. It's just that, you know, this is a collective challenge, globally collective challenge. And if 70% of emissions are coming from emerging markets, you know, I can't see the developed world having much of a choice. There's one other hand up. I'm just going to take this question from Ari, and then we'll go to that hand. But thank you for that question, or those questions. How do you address short-term financial thinking? For instance, discount rates devalue the future, and even pension funds should have long-term horizons. And they often get that wrong. Okay, so how do you address short-term financial thinking? So firstly, I think if there's a great answer to that, I think that's a really important answer to have. So if you have a view, I'd be very interested in that. My personal opinion is that you have to think about how remuneration structures work in finance companies. I think that's, you know, in fact, how remuneration structures work at leadership levels, I think is probably, you know, in businesses, but also in finance organizations. So currently, you know, people are paid for performance, and there isn't a patience to understand that performance over a long time period. So I think that's probably at the core of the problem, is how remuneration structures work and how they push people towards short-termism, I guess, is the answer. Okay, here we go. There was a question about, are these certificates recognized in Europe? And the answer is yes, absolutely. In fact, the ESG certificate was first launched by CFA Society UK, and then globalized by CFA Institute. So it's well recognized in European markets. And then the climate risk valuation investing certificate has received really, really positive feedback. It's quite a different animal to the ESG certificate. But again, that was a review done by a European organization, an asset manager in this instance. Is the US a leader or laggard in ESG reporting and compliance, and does this matter to the rest of the global economy? Okay, so I don't know the answer to the first question. Okay, just because I think the politicization of sustainability has clouded to some extent some of the work that's being done in the US. So, for example, if you have a look at the US energy mix, it's quite interesting how that's changed. And you know, if you look at per capita emissions in the US and how those are declining, that kind of seems contrary to sort of public debate. So with respect to ESG reporting and compliance, I guess that I would say, maybe I can answer this positively. I think Europe is a leading indicator. All right, I think that's probably the way to look at it. And if, you know, I don't have a view on the US as a leader or laggard. I think there are companies within the US that are both leaders and laggards. You know, as a wider market as a whole, I think there's just a mix. And so I don't mean to sit on the fence, but you know, that's a tough question to generalize across an economy that size. What are the hardest problems to be solved you've seen in carbon accounting and reporting that can enable in companies more voluntary? Okay. And you're asking from a software tools developer point of view. So this is off the top of my head. I don't specialize in carbon accounting or reporting, though. Obviously, it's a big part of the surrounds of the work that I do. I would say that scope 3 is probably a very important challenge to resolve. Okay. And if you think about so scope 3 is your full supply chain of emissions, upstream and downstream. So if you think about how small a business might be that forms part of a big organization supply chain. So if you take a complex company like Unilever or something like that, so it's got this incredible supply chain. And I think it's massively challenging to understand the emissions across that supply chain. So I think that's probably a challenge that's probably why scope 3 is not being mandated in many scope 3 disclosures have not been mandated. But I would say that's probably the challenge, and they kind of there are lots of concerns about how that data is collected, analyzed, etc. So I would say that's a key issue. And I think that to go to your second part is I think uncertainty about that, stops voluntary reporting in that space. So I would say that if you were looking to develop tools that would help small businesses in remote places effectively calculate their emissions at a low cost without the need of consultants and whatnot, I think that would be a significant contribution, would be my view. Okay. How can finance professionals, specifically LPs, forecast expected carbon emissions of companies or portfolios in such a way that doesn't burden fund managers with additional surveys, etc.? Okay. I don't know the answer to your question, Esther, but it's an interesting question, and I will try and ask some people who may. And in fact, I think the answer to that question, if you have a look at EMI in Australia, EMMI, okay, that is a carbon diagnostics business, and it's very interesting. It's a CFA charter holder with one of the contributing IPCC scientists or the founders. And they are using machine learning algorithms, a range of different tools to I'm not sure if they'd want me to use the word forecast, but certainly tools to kind of calculate what probable emissions are where there isn't good data. So I would knock Esther, I would knock on Emmy's door and have a chat to them. Michael Lebon is the CEO there. I hope he's not going to shoot me for saying this, but I think he'd be interested in helping, and certainly worth having a look.
Yeah, and so let's get to the question that we have to raise hand, and we'll move.
Oh, forgive me.
Right. Oh, you're doing this is great. I just don't want to keep you too long. So
no problem. Let's go.
Work on Climate had their hand raised.
Yeah, and there's can ask to unmute. So maybe I'll just
no worries. Maybe they'll come back. Well,
okay, sure.
Sorry, I think there was one more in the chat we could wrap up with.
Sure. Oh, thank you for the kind words. And it's wonderful. So it was just a statement. I did the ESG certification, and as independent ESG consultant, I must say it was, valued by my clients, who are mostly from the financial sector. Well, thank you for the shout out, Concona. I really appreciate that, and I'm delighted that it was, as we intended to be. How do financial institutions view or value industry experts who conduct ESG and sustainability assessments? and what is needed to move from a straight industry role into the financial role in assessing companies. Okay. So let me try and answer this. And again, I'm offering you opinions based on, you know, a fairly narrow corridor of experience. Financial institutions view people who conduct ESG and sustainability assessments, LSAs and the likes, very positively, in my opinion. Okay. And I think that to the extent that those are probably sought after skills in many financial institutions. So I would say positively. And certainly in my market, I would say very positively. Okay, so, you know, I know it's terrible to generalize about a whole region, but yeah. And then the second question, what is needed to move from straight industry role? So, and I assume you mean, you know, ESG and sustainability assessment industry role, into a financial role. And the answer to that question, and this is going to sound like I'm pushing programs, but the answer to that question is CFA level 1, at least. Okay, so that is, and again, if you think back to that sort of what ESG integration is about, it's about taking traditional financial analysis and then how you make adjustments to that traditional financial analysis as a result of considering sustainability issues. Now, the implication is that you need to be able to do that traditional financial analysis. So I would really strongly recommend the CFA program. I don't think there's anything that comes close to it in terms of value and quality. Okay, so kind, thanks.
Well,
brilliant. So there's just,
yeah. Okay.
Sorry to interrupt, Jonathan, but just there's such an interesting point from Concona here. If it helps, I work on Scope 3 measurement for funds, and one of the models for emerging markets where data is not easily available is the joint impact model as an option. The other is xtons.com, but I haven't used it personally. So I think that's so helpful. So just to the other, you know, question that was asked, that's great. And Concona, if you're not a member of Work on Climate, I'd recommend joining it, because I think that you've got some expertise that people would really value. Okay. All right. I'm just checking if there are others. Okay. My colleagues have been on fire here. All right. Thank you so much. Jonathan, thank you. Thank you, everyone.
Thank you, Richard. This has been awesome. Again, thank you everybody for joining. I appreciate hanging out after time to hear more from Richard. Like I said, we're going to be moving this over to the Learn Finance Slack channel. So feel free to join us there, and I'll probably post some more of the questions. We'll do the AMA for the next 24 to 40 hours, and we'll be posting the slide deck and recording. So appreciate your time, Richard, and thank you everybody else for your interest. And again, we value your feedback. So please take the survey and let us know how we did, how you enjoyed it.